Hello everyone, welcome to the Stock Trading Tutor channel. If you would like to create a free DMAT account, click the link in the description and fill out your details. Now, let's look at how to read cash flow statements which are required for fundamental analysis. The cash flow statement of a company gives an account of the cash movements into and out of a company during a year. Although the income statement also shows incomes and expenses, some of them do not involve an exchange of cash. Income statements are based on accrual accounting, meaning they even consider incomes and expenses that are due, but where cash has not yet changed hands. The income statement also has items like depreciation, where cash will never move into or out of the business. Such items are removed to show the pure cash position of the company. It also includes cash inflows and outflows that are recorded on the balance sheet. Now, how to read cash flow statement. Companies present their statement of cash flows in one of two formats, direct and indirect. The indirect format is more common. Cash flow statements have three segments: operating, investing, and financing. The idea is to see where the company generated most of its cash during the year and where it was spent. Operating cash flows. In the indirect format, the operating section of the cash flow statement starts with the company's net income. This, this comes straight from the income statement. Net income includes net operating items as well as non-cash items. These have to be removed to arrive at operating cash flows. Non-operating items are removed first by subtracting non-operating incomes and adding non-operating expenses. This gives the company's earnings before tax for the year. Next, non-cash incomes are subtracted from the EBT and non-cash expenses such as depreciation, and they are added to it. The next set of adjustments are to remove the non-cash items that come from the balance sheet. Increases in current assets and decreases in current liabilities represent an increase in non-cash working capital. As such, they are subtracted. Similarly, increases in current liabilities and decreases in current assets represent a decrease in non-cash working capital and are added back. The cash flow statement illustration below shows this adjustment. Now let's look at investing cash flows. In this section, adjustments are made for cash flows related to investments in fixed assets such as land and buildings and financial assets such as securities of other companies. The investing section includes cash flows from sale and purchase of fixed assets and so on. The sale of any of the assets listed above and the receipt of interest and dividends are cash inflows. They are added when calculating investing cash flows. All purchases listed above involve cash outflow and are subtracted when calculating investing cash flows. Financing cash flows. This section includes the cash inflows and outflows related to raising and repaying debt and equity capital. Some of the six types are inflows from raising fresh debt capital, inflows from issuing fresh equity, outflows on account of debt repayments, and so on. Now, how to analyze the cash flow statement? Operating cash flows are the heart of the cash flow statement of a company because they come from the company's core business. Companies with consistently high operating cash flows are healthy and self sustaining. Companies need to continuously invest in strategic growth opportunities. They also need to repay their debt and pay out dividends to shareholders. This means they often have negative investing and financing cash flows. Negative investing cash flows indicate that the company is expanding or replacing old assets. We should try to find out the purpose of these investments and evaluate if they generate revenue growth in the future. Negative investing cash flows are also typically accompanied by positive financing cash flows. This is because companies raise additional debt or equity capital to support their investments. Consistently low or negative operating cash flows and positive investing cash flows mean the company is funding its operations by selling its assets. These can be signs of an ailing company that may be on the verge of bankruptcy. However, you should also consider if the company is selling key assets and consistently positive financing cash flows and low or negative operating cash flows indicate that the company is not using its capital optimally. This is a sign of operational inefficiency and improper management. So when you're reading cash flow statements, you should be aware of all these issues and make your analysis accordingly. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you would like to create a free DMAT account, click the link in the description and fill out your details.